And more good news for the economy on the huge service side this time. For August, a survey of non-manufacturing firms like restaurants, retailers and home builders found the fastest growth in 3 months. The Institute for Supply Management climbed to 56.4% from a 3-year low of 53.7% in July. Now, keep in mind, numbers over 50% are viewed as positive for the economy. Anything over 55% is considered exceptional for the economy. All right, to discuss the state of the economy, the markets and more, we're joined by Aquiles Larrea. He's the CEO of Larrea Wealth Management, and Michael Lee, market strategist at LTM Wealth. Good to have you both with us.
Thank you for having me.
All right, Aquiles, you've always been pretty optimistic.
Super bullish.
You have been. You have been. How optimistic are you, though, that these trade talks are really going to amount to something this time?
Well, I don't think we're going to have what's called a panacea at these trade talks in October. I think it's the beginning of something positive, and if it should continue, the market loves that certainty, so we can see that going forward as a positive sign, and the markets to go up even further. We also see these job numbers. Hopefully tomorrow they come out stronger than indicated, and we're going to see even more run up in the market.
Well, it's the certainty of uncertainty, because we don't know what's going to come out of these talks. We just know that potentially there will be another round if they don't get canceled between now and then. Michael, are you thinking that this is going to be a game changer of any sort, or just sort of continuing the process so that from the Chinese perspective, their stock markets don't panic, and their economy also likes the illusion, perhaps, that things are progressing, and certainly it helps the U.S. markets?
Yeah, look, I think it's good and it's settling for markets in the current. But I don't know that a trade deal will get done with China. The U.S.'s demands have been crystal clear. They had a deal in April. China pulled out. So what I think is China's trying to play against the clock and see if they can get the Trump administration to fold. And I think the Trump administration is far more serious about a complete withdrawal from China than they are with putting together a deal just to placate the markets so we can get through to the next election. So I'm as an investor, I'm very happy to see the talks and positive headlines because it pushes stocks higher. What I'm even more happy to see is the underlying fundamentals of this economy, even with all this trade uncertainty, continue to look really, really good.
So, Michael, what does that tell you, that the U.S. economy, even with all of this trade uncertainty, continues to be on fire?
Well, I'd say that way too much energy is devoted to these trade talks in terms of how stocks are traded and how people are looking at them. The actual impact to the underlying economy, we haven't really seen it yet. We've seen a slowdown in business investment. Okay, that could also be attributed to the fact that in 2017 and 2018 it was so high above trend, so far above trend, that we're getting a little bit of mean reversion. So maybe this has slowed down some future investment, but in reality, we've been under 250,000 weekly jobless claims for almost 100 straight weeks, something that's never happened before.
Aquiles, I see you nodding in agreement. Do you also think that the U.S.-China trade talks have been over-exaggerated in terms of their impact on the U.S. economy?
Yeah, I mean, it's a blip on the radar screen. We're talking, in the United States, historically low inflation, historic employment numbers, This is something that we have given way too much credence to, I believe, in my opinion, and there are several other factors out there that can be just as interesting to the market to run it up or to bring it down.
But the issues are real. The issues that the Trump administration is trying to tackle, Michael, are very real. And the trade imbalance is perhaps the least significant of those issues when you look, again, at those intellectual property violations that Beijing continues to go through, continues to ignore World Trade Organization rules and regulations. So it's not like this is an issue that doesn't really have some real substance behind it.
It's not only the theft of intellectual property, it's trying to subvert the U.S.'s interests all over the world, pressuring all our allies in the South China Sea, saying, hey, you're either with China or the U.S. China is not looking to simply gain market share in auto manufacturing like, say, the Germans or the Japanese. They're looking to completely subvert the American economy in favor of, the communist kleptocrats that run the Chinese this country.
So, Aquiles,
I would take it a step further.
Okay.
Not only are they subjugating, they are actually going to other countries. I'm looking at my father's country in Ecuador, in Honduras, and Central American countries. They're going into the Amazons. They're going into building dams. They're building other things where that Silk Road is being discussed, and they're doing it throughout South and Central America.
And also in Africa, a big commodity play. All right, are you concerned about a recession still?
Yeah, I'm still concerned about a recession. It's funny, we talked about this in the green.
How can you be bullish about the markets and still be concerned about a recession?
Well, that doesn't mean it's going to happen tomorrow. You know, what I'm thinking as far as recession is concerned, is this trade war, should it be prolonged? Should we stop talking? Is this going to push us into a recession earlier than we had discussed? I'm thinking a year and a half. Some people are talking 2 years, you know, and it could very well happen.
So what's the play then? If you believe a recession is coming within the next year and a half or so, how do you protect yourself? What's the investment advice?
I would hedge that and say, if anything, the trade war will prolong the time between now and a recession, because for us to enter, because for us to enter a recession, we need to form some sort of bubble. So the yield curve inverted last week. That was the talk of the town, right? So when the yield curve inverts, typically what happens is the Federal Reserve cuts rates aggressively, and massive leverage is taken on either by corporates or by households, and that creates a bubble that bursts. So if we don't get that aggressive cutting by the Fed, and we don't get this aggressive levering up and spending and this boom before we bust, I don't think we'll see a recession. Maybe something small or something minor, but you know, if that does come, maybe some gold or some long-term treasuries.
All right.
I'm looking at 3 different areas, and you know, not everybody has participated in this market boom that we've seen recently. So looking at American Water Works, that's one of the companies that we're following. We also believe that Apple has a wonderful, because they're innovative, and companies that are innovative will always trump companies that have problems during recession.
Still a fan of the FANGs?
Still a fan.
All right. Thank you so much. Appreciate your insight. Aquiles Larrea, CEO of Larrea Wealth Management, and Michael Lee, market strategist at Altium Wealth. Thank you.